massive packed party, right? And the music is just absolutely blaring.
Yeah, everybody's on the dance floor, total euphoria.
Exactly, total euphoria. But then you look over and notice a few people, usually the ones who've been to a lot of these parties, and they're dancing, sure, but they have their backs pressed right up against the emergency exit.
Right. I mean, they're participating in the upside because they don't want to miss out, but they're keeping one hand firmly on the door handle.
Ready to bolt the second the lights flicker.
Yeah.
And honestly, looking at the broader market right now, it feels like we are at that exact kind of party. Welcome to Weekend Recap. I'm Daniel.
And I'm Mira.
It is Sunday evening, August 9, 2026. And the mission for this deep dive is simple. We're going to extract the critical market narratives, break down the past weekend's pretty intense events, and most importantly, help you understand the exact macro baseline you're operating against as you enter the new week.
And just to set the ground rules right up front, everything we unpack today is strictly from market context and macro analysis. This is not personal investment advice or, a recommendation to buy or sell anything.
Right. So let's open session one. How did the market digest the past week's massive swings? Because, the price action we saw was just nothing short of historic.
Oh, absolutely historic. We had this massive risk-on rally. The S&P 500 gained 3.6% to hit a record 7,757.
Yeah.
But the real story, like the absolute engine of this move, was the tech-heavy NASDAQ composite. It skyrocketed 671 points on Tuesday alone and closed the week above 26,690.
Which is wild. And this was completely driven by tech earnings that strongly validated that whole, what we call the AI Capex, as a self-referential valuation loop.
Right, the Capex loop.
But before we throw more jargon around, let's just ground that. What exactly is that loop for anyone new to the frame?
It sounds complicated, but the mechanism is actually pretty straightforward. Capex just means capital expenditures, the money companies spend on physical assets.
Right, hardware, data centers.
Exactly. The mega cap tech giants are spending tens of billions of dollars on AI infrastructure. So the market looks at that massive spending and basically says, wow, if they're investing this much, the future profits must be guaranteed to be astronomical.
So the spending itself justifies the high stock valuations.
Yeah, and then those high stock valuations give the companies the financial leverage to keep spending. It's a loop. As long as the spending continues, the valuations hold up.
Which totally explains the euphoria on the tech side. But the catalyst for the broader macroeconomic move, the reason this rally had so much fuel across the board, actually came from a shock to the labor market, of all things.
Yeah, July payrolls unexpectedly fell by 23,000.
Right. And simultaneously, the unemployment rate dropped slightly to 4.1%. Now, I have to stop here, because I'm looking at these payroll numbers. A drop of 23,000 when the market forecast was, an 80,000 gain?
Yeah, an 80,000 gain forecast. It was a massive miss.
That is a massive miss. So for anyone not staring at Bloomberg terminals all day, how close is that to the recession alarm bells ringing? Because normally losing jobs is, a bad thing. Why did the stock market celebrate it?
That is the ultimate paradox of the current market. And it really comes down to a dynamic we call the bad news as a Fed cut chicken game. Where you have to remember that for the last couple of years, the stock market has been desperate for the Federal Reserve to lower interest rates because lower rates mean cheaper money for companies to borrow and grow. But the Fed won't cut rates if the economy is running too hot because that fuels inflation.
So the market sees a shrinking payroll number and essentially calls the Fed's bluff.
Exactly. The market assumes this weak labor data will force the Federal Reserve to step in and cut interest rates to prevent a full-blown recession. They're celebrating medicine, the impending rate cuts, before the disease actually takes hold.
Wow.
And you can see this assumption playing out in the bond market perfectly. Because of that labor data, we saw the 10-year Treasury yield plummet from 4.745% down to a midweek low of 4.617%.
Wait, let's break that mechanism down for the listener. Why does a shrinking payroll number automatically make bond yields plummet like that? And how does that affect everything else?
Well, it comes down to supply and demand for safe assets. When investors see a bad jobs report, they anticipate the Fed cutting interest rates.
Right.
If the Fed cuts rates, newly issued bonds in the future will pay less interest. So investors rush to buy up the current bonds right now to lock in the higher yields. That massive wave of buying drives the price of the bonds up.
Right, because bond prices and bond yields move in opposite directions.
Exactly. The effective interest rate on that bond plummets. It eventually closed the week at 4.66.
Okay, that makes sense. But then how does that falling yield pressure the U.S. dollar?
Yeah.
Because we saw the dollar index drop to 99.61 on the back of this.
Right, because capital is completely global, and it always flows to where it gets the best return. If U.S. Treasury yields are dropping rapidly, foreign investors aren't getting as much bang for their buck.
Makes sense.
So they start moving their money to other countries where interest rates might be relatively higher. To do that, they have to sell U.S. dollars and buy foreign currencies. That selling pressure causes the value of the dollar to drop.
It is just fascinating how interconnected every single data point is. But here is where I have to push back a little on this whole narrative. Is it just, I don't know, too neat?
How so?
Well, if equities are throwing a party, celebrating a soft landing where inflation cools and we get rate cuts without a recession, why did gold stage a massive headline-worthy breakout? I mean, we are talking about gold surging over $360 to close at a staggering $4,399.20 an ounce. Meanwhile, WTI crude oil fell to $77.11 a barrel, with Brent crude dropping almost 9% to $82.23.
Right.
There is a real tension here. The stock bulls are celebrating, but that gold breakout is the exact emergency exit we talked about at the beginning of the show.
You are spotting the exact fracture line in the global economy right now. Equities are pricing in a perfect world. Rate relief, continued growth, soft landing. But gold doesn't care about a soft landing.
Definitely not.
Gold is a historic hedge against systemic instability. It is pricing in severe geopolitical fragility and the risk of sticky, long-term inflation. The fact that crude oil dropped while gold skyrocketed suggests the market is deeply worried about global demand slowing down while simultaneously seeking shelter from geopolitical shocks.
That perfectly frames the conflicting signals from last week's stock euphoria on one side, gold's blaring warning siren on the other.
Exactly.
Which brings us to a short break. Stick around, because when we come back, we're going to unpack exactly what happened over the weekend to completely shift this landscape.
Welcome back. Let's move into session 2. What happened over the weekend, and how does it shift our macro baseline?
We have a lot to cover here.
We really do. And going right back to our Watch Next section from Friday afternoon's close, we noted the market was bracing for Tyson Foods earnings on Monday morning, some U.S. Treasury bill auctions, and a general lack of U.S. economic data over the weekend.
Right. Plus, Japan's Mountain Day holiday thinning out yen liquidity and those ongoing Hormuz negotiations.
Exactly. But what actually materialized was a massive shift in the AI narrative. We're transitioning from Friday's tech rally to a weekend defined by massive capital raises to solve what is now the critical choke point of the entire sector. AI infrastructure as a physical execution bottleneck.
It really is the defining challenge right now.
For the past year, the focus has been on designing the chips. Now, the realization has set in that you can design the most advanced AI chips in the world, but if you don't have the electricity to power the data centers that house them,
they're effectively useless.
Completely useless.
Let me use an analogy here, because it feels exactly like spending billions of dollars to design and build the world's fastest, most futuristic sports car. But right before you turn the key, you realize the car takes a completely new type of fuel.
Yeah.
And to get that fuel, you have to personally finance and build the power grid, the transmission lines, and the gas stations just to be able to drive it off the lot.
That is precisely what is happening. The hardware evolution has outpaced our civic infrastructure, so these tech companies are suddenly being forced into the utilities business.
Crazy.
Just look at the staggering numbers from this weekend. Alphabet filed for a massive $25 billion multi-part corporate bond offering to fund this infrastructure.
$25 billion. That is just massive scale.
And Nvidia wasn't quiet either. They committed up to $3 billion to a Blackstone-backed energy developer called Stargate. On top of that, Nvidia acquired a 20% stake in a company called Lancium for $2 billion, which could potentially scale up to 30% with another $1 billion. Lancium focuses on building data centers near renewable energy sources. This is purely to secure power grid capacity.
Purely for power.
Yeah. Meanwhile, a company called Firmus raised a fully subscribed $2 billion strategic equity round specifically for building Asia-Pacific AI factories.
So the tech giants are realizing that the physical world is catching up to their digital ambitions. And speaking of physical world friction, there's another hardware story over the weekend. Apple is reportedly testing Chinese CXMT memory chips for iPhones and MacBooks in an effort to diversify their supply chain.
Right.
That adds a whole new layer of geopolitical friction to the hardware space, considering the ongoing trade tensions.
Geopolitics is definitely the other major theme that escalated over this weekend, particularly regarding energy risks and supply chain fragility. We have these ongoing negotiations involving the US, Iran, and Oman trying to establish a temporary shipping route to bypass the conflict in the Strait of Hormuz.
But the tension there is just palpable.
Oh, absolutely. Iran's Revolutionary Guard stated that any reopening completely hinges on U.S. concessions. And just over the weekend, the UK MTO reported a commercial vessel was hit by a projectile just 18 nautical miles east of Kasab, Oman.
You know, the market reflex is often to treat these geopolitical shocks like unpredictable natural disasters. A hurricane hits, oil spikes, a conflict flares up, shipping rates jump. We tend to view them as these random acts of chaos.
I'd actually challenge that reflex, though. We shouldn't view these as natural disasters. This is game theory brinkmanship.
Right.
Every drone strike, every negotiation pause, every rerouted ship is a highly calculated move on a geopolitical chessboard to gain leverage over energy prices and global inflation.
That makes a lot of sense. And if we look at the board state over the weekend, it escalated significantly. We saw Israeli Prime Minister Netanyahu officially reject a 15-point Gaza peace proposal.
Yeah.
Over in Eastern Europe, there were heavy drone strikes by both Ukraine and Russia hitting critical oil refineries, specifically Russia's Ilsky and Syzran facilities, and Ukraine's Sumy refinery, plus damage to the port in Odessa.
Right.
And in direct response to this regional instability, Turkey, Pakistan, and Saudi Arabia established a NATO-style mutual defense pact specifically to secure Red Sea shipping.
When you group all of those events together, the underlying narrative isn't just about regional conflict, it's about deep supply chain fragility.
Yeah.
If the arteries of global energy are under constant calculated threat, the cost of moving goods and powering factories stays permanently elevated. Although on the supply side, Colombia's newly sworn-in right-wing president just permitted fracking.
Oh, wow.
Which does send a signal about long-term non-OPEC oil supply expansion attempting to offset some of this pressure.
So you have all these moving pieces threatening to keep energy and shipping prices high. But then we got a totally contradictory signal out of the broader global economy over the weekend, specifically from China.
We really did. China released some very weak weekend data. Their July Consumer Price Index, or CPI, completely missed expectations, coming in at an inflation rate of just 0.5% year on year.
That's incredibly low.
Food prices actually plunged 1.5%, and their Producer Price Index, which measures the cost of goods leaving the factory gates, slid 0.7%. This is a real deflationary signal from the world's second-largest economy.
You've mentioned before the risk of central bank paralysis under supply-driven stagflation. That is a mouthful.
Yeah.
Break that down for me in the context of what we are seeing between the geopolitical supply chain shocks and China's deflation.
Sure. So stagflation is the nightmare scenario where you have high inflation and a stagnating, slowing economy at the exact same time. Usually, if an economy is slowing down, central banks cut interest rates to boost it.
Right, the usual playbook.
But if inflation is being caused by supply chains breaking down, like shipping lanes being attacked or oil refineries being bombed, central banks are paralyzed. Cutting interest rates doesn't fix a bombed oil refinery. It just makes the inflation worse by pumping more money into the system.
Wow, yeah.
China's deflation shows the stagnation side of the risk, while the Middle East shows the supply-driven inflation side. It leaves global central banks in a very difficult spot.
And back in the U.S., the Federal Reserve is facing its own localized pressures. The Senate passed a stopgap funding bill to avert a pre-election government shutdown until December 20, which removes one immediate hurdle.
But the political risk isn't gone.
Definitely not. The Trump administration is aggressively pushing to fire Fed Governor Lisa Cook. At the exact same time, you have hawkish Fed member Alberto Musalem warning publicly about unanchored inflation. The institution itself is under immense pressure from both sides.
It is just a phenomenal amount of structural news to process in 48 hours. I mean, we went from Nvidia literally buying into power grids to secure electricity to global deflationary signals in China and calculated geopolitical stalemates across the Middle East and Eastern Europe.
Slot, which perfectly cues our next transition. We're going to take a quick break, and when we come back, we'll pivot to how you can actually trade this in the coming weeks.
Sounds good.
All right. welcome back for Session 3. What should you be watching in the coming week? Using our weekend What Next guide, what are the specific upcoming catalysts you absolutely need to have on your radar?
Well, between August 10 and 14, you absolutely must monitor those Iran and Oman Strait of Hormuz corridor negotiations. This is the key swing factor for crude oil prices, inflation break fence, and that massive gold rally we discussed.
Okay, what about the domestic side?
From Tuesday to Thursday, August 11 through 13, keep an eye on the U.S. Treasury coupon auctions. We have the 3-year note on Tuesday, the 10-year on Wednesday, and the 30-year on Thursday.
And those matter because
How much demand there is for those bonds will dictate near-term risks for the Treasury curve and, by extension, equity valuations.
But the main event, the one that will likely dictate the market's mood for the rest of the month, is absolutely Wednesday, August 12 at 8:30 a.m. Eastern Time. That is when we get the July US CPI and core CPI prints.
A huge data point.
This is the primary test for those Fed rate cut expectations we talked about earlier. If inflation comes in hot, that whole bad news is good news rally from last week could unravel very quickly.
Absolutely. And following that, on Thursday, August 13th, also at 8:30 a.m. Eastern Time, we get the July U.S. Producer Price Index, or PPI. We watch this closely for pipeline inflation pressure.
Let me stop you there. What exactly does pipeline inflation pressure mean for the average listener?
The PPI measures the prices companies pay for their raw materials and wholesale goods before they sell them to you. If it costs a furniture company more to buy wood and steel today, that price increase is in the pipeline. Eventually, usually a few months down the road, they're going to pass that cost on to the consumer, which shows up in the CPI later. So PPI is a leading indicator. It tells us what consumer inflation might look like tomorrow based on what factors are paying today.
Got it. And finally, on Friday, August 14th, advanced retail sales drop at 8:30 a.m. Eastern Time, followed by the preliminary August University of Michigan Consumer Sentiment Index at 10 a.m. Eastern Time. Those will give us a direct read on how the U.S. consumer is holding up amid all this volatility.
It is a densely packed week of macro data following a weekend of heavy structural shifts.
It really is. You know, after a week where Nvidia practically bought its own power grid, Alphabet filed for $25 billion to fund its power-hungry AI, and the Fed split into factions over a negative payroll report, you'd think you could sleep easy this Sunday.
You'd hope so.
But with gold sitting at record highs, shipping corridors still actively contested, and a massive CPI print dropping on Wednesday, the only thing more volatile than the market is our collective Sunday scaries.
Oh, absolutely.
So let's raise a glass to the tech giants spending hundreds of billions on the future of AI. We just have to hope they also programmed a model that can tell us whether we'll be retiring early or working forever by Tuesday morning.
A fitting summary to reset our expectations for the week. That wraps up our main macro analysis, but don't go anywhere.